Hello traders, and welcome back to the final part of the market profile section. As I said in the first part, I was either going to split out the first and the second half, or do the second half separately. Obviously, the first half ended up being about 2.5 hours, but I hope you agree it was necessary. You needed to understand, obviously, the trading hours, why I look at the markets I do, what the market profile is, why I even use market profile. So all of that needed to be covered thoroughly. So hopefully you got a really good idea now of why that's happened. But look, it's pretty exciting now. We're going to get you on the charts. This is very much task one of the pro course. So I'm going to get you on the charts. So, let's get you doing some exercises and get you actually building some practical knowledge of all the theory, and let's get you putting that theory into action, which is why we're all here, isn't it? Ultimately, to make business decisions and see if we can develop some edge. So this is very much, I was going to say the first phase, but it isn't necessarily the first phase, is it? Because you've done a great amount of work already on the depth of market. So really, that was the first phase, but this is really the main first phase on a chart, and very much, if you decide to follow obviously the path that I've followed, then very much the rest of your career is starting here, because we'll move away from the depth of market and just get you on the charts now. So, but what I'm going to do is essentially I'm going to make this the final part of the context section. So it's important I say this here, is that doesn't mean that VWAP, fundamentals, and this bit, acceptance and rhythm, don't form part of context. They very much do. But what it is I've recognized that this section, at least in terms of hours of learning and theory, and now this little bit of practice, I think it's enough for this particular section. And what I really want to do is, you see, because the problem is, when you come to look at the market from a little bit more of a, because what you'll notice is with the market profile, when we do composite structure, as you see, I already started talking about, I'm looking at a week, I'm looking at several days. Do you remember I said the weekly profile, it gives us some problems, and therefore, obviously, by default, the fact that I'm looking even at a weekly, I'm clearly not looking at just one day by doing composites. I'm obviously trying to look for balance areas over multiple days. So the problem comes is when you go to do intraday analysis, i.e. using VWAP on an intraday, there is going to be some overlap with this section. And actually, you see, it will make sense when I didn't really want to get too far ahead, but I kind of have to, just to explain to you why I'm cutting, at least in terms of the learning, why I'm moving some of this stuff to stage 2, at least in terms of the modules, is because, so coming back to the VWAP, I use VWAP on a daily, when I say daily, I don't mean daily time frame, I mean on the day, essentially. So I use a VWAP for the day, which is the intraday, but I also use VWAP for a week. So I look at what is the volume weighted average price and the standard deviations, developing value. Now, don't worry if that doesn't make sense. I'm going to explain why it's called developing value. And you can see I've written it here, developing value versus static value. I'll talk a little bit about that. Obviously, with volume profile, as you can see historically, they do tend to be static. They've already formed. But again, don't worry if this doesn't make sense. I'll explain it thoroughly in the VWAP section, but VWAP is a much more of a fluid form of value that's forming throughout the period that you're looking at. So it's very much an intra-period value measure, whereas profile is much more of a historical and static measure. But we'll discuss that going forward. But again, the point is that there's a lot of overlap, because I'm looking at VWAP, right, over a week, over a month, over a quarter, but I'm also looking at over a day. But when I teach you VWAP, I'm going to start with the day. So you see, what's going to happen is I'm going to look at VWAP over a day. I'm going to teach you, but then I'm going to have to come back to the context section and teach you VWAP over the week, the month, right? The quarter, the year. So do you see, I'm going to have to keep chopping and changing. So what I thought is, at least from a teaching perspective, the way that I split it out is I thought, you know what? It makes sense. Why don't I put, so we've done auction market theory, right? Stage 1, we've done volume profile, obviously, theoretically anyway, and we've done market profile. So, and they've been huge sections, as in we'll finish market profile in this part B. So I thought, why don't I join these up and then see with VWAP, fundamentals, let's leave that to the side for now. I might talk a little bit about it. I don't really use them, but I think it's important that at least I add a section in on them at some stage, but I'm going to probably do that much later. But with the VWAP, because like I said, I'm looking at it from a weekly, monthly, quarterly and yearly perspective, these really do belong in the context section. And then I'm looking at this also from a day perspective, which obviously belongs in the intraday section. But the problem is, like I said, I'm going to be starting here and then I'm going to come back here. So rather than, getting all the modules all over the place, I thought, why don't I just move VWAP here, essentially, and I'll just teach you the entire VWAP here. So I'll do daily, weekly, monthly, quarterly, and yearly VWAPs. We'll do them in stage 2. But when you actually come to viewing the market, you've got to remember these VWAPs very much belong here. So hopefully, I apologize if that sounded a bit confusing, but by the end of it, it will make much more sense. So just, bear with me. It will make a lot of sense once we actually finish learning VWAP. And then I'll explain, look, I've taught you VWAP across the board. These particular volume weighted average price measures, I want you to use as part of your contextual prep, your preparation for the day. And then obviously VWAP, when you're looking at it from a day perspective, I want you to use it in the intraday. So I'll split them out for you, but just in terms of the modules, like I say, I'm going to end stage 1 with this part B of market profile. And then, we can move on to stage 2 and start looking at VWAP next. But look, for the time being, I want you to stick to just doing this task, which is market profile, and really starting to learn how to develop composites yourself. So what we'll do is let's move on to the next slide, and all of what I've said is going to start making sense slowly. Let's just focus on looking at value from one perspective at this time and point, and then we'll build value from different investor perspectives as we go along and develop understanding of obviously VWAP across different time frames, and we can look a little bit at profile as well. But really, I'll be honest with you, what you're about to see, how I combine profiles, is pretty much the foundation of everything I do. For the reasons that you saw in auction market theory, I'm looking for balance areas, and obviously it will vary. And I'll explain this depending on your horizon. If you're a longer term investor, your composites are going to be obviously much larger than someone like me who's more an intraday trader, but we can discuss that. So let's go to the next slide and then finish off part B. Okay, so like I said, very much I'm going to be getting you to be very hands-on. As soon as this particular section of me talking finishes, I'm going to get you on the charts, doing composites. It's going to be really exciting for you to really get your feet wet, really, and get stuck in. But before I do that, obviously there's some things it's going to be very helpful for you to understand, some of the pitfalls you may face as you're doing this task. Because, with the depth of market, obviously the task wasn't necessarily to get you to look for trading opportunities, was it? It's not something I want you doing for the rest of your life. In fact, I don't want you doing it anymore. That's it, done. If you've done the 3-4 months that I asked you to do, you should be incredibly competent at the things I wanted you to learn, the absorption, market orders versus pending orders, fake bids and offers, and just understanding how volume profile develops, right? Because if you've done all of that, it's really going to be helpful for you, and you're going to be so far ahead of anyone else in a professional firm who starts looking at profile, because you've put in that time watching how profile develops. And you'll notice you'll be able to, the more time you put on the market, watching profile develop. I know it's a bit boring because you weren't necessarily looking to make money, but there's a very good reason why I didn't want you to get obsessive over making money, and it will only become much more apparent later. It's to do with obviously algos and lack of opportunity, and I don't want you to waste your time doing something that isn't going to get you anywhere. And I said that before, and I don't want to go off topic here, but it's important I say it, that I'm seeing it increasingly as algorithms are obviously becoming more and more part of the market, almost 80% now, and heavily dominating the depth of market supply columns. There's just no opportunities anymore for individuals like there used to be. And I've said it before, it's very sad for me to see even professional firms just continually try to do something that isn't working anymore. And that's why I don't want you to fall into that trap. That's where my experience is really going to help you, because I'm trying to just get you looking at it. And I know I've said this multiple times before, but it's just because I know some of you will have been looking at the depth of market for the first time and think, no, I don't want to get away from that because it's amazing. But believe me, what you're about to do now is 10 times more amazing and infinitely more powerful, and you'll see that. And which actually leads me on to my next point. So why? What is it? What are we actually looking for when we're building these composites? Well, if you think back to the section where I got you to do some of the exercises on the depth of market, and I've explained this a lot during auction market theory, that really, what is the market? No matter what perspective you're looking at it from, it is the depth of market, right? I got you on a depth of market for what? Intraday, one day. If you think of market profile, I've shown you this obviously in all the sections, but in particular the last section, it's just profiles over a period of time. But whether that volume profile on the left is microscopic, like I said, where on the dome it's very tick by tick, or whether you're looking at it from a bird's eye view, it's the same thing. So why do I say that? Because in that section, what did I get you guys to do? I said that we're looking for either the market to return back to value or move away from value, i.e. mean reversion, or go out of mean reversion and move to a different part of the profile. But what we're going to do is we're actually going to define that now, and we've already defined it: balance and imbalance, right? So that's basically all we're doing, but we're just doing it from a wider lens, and I'll explain why we do that in a moment. And I have explained it many times. As I've said, it's to do with taking advantage of the edge that we as human beings can develop, and you'll very much see that when we're building composite profiles, because it's, as I show you, it's very difficult for an algorithm to do what we're about to do, and this is an incredible opportunity for us to build alpha, which is something I recognized early on in my career. But I'll come back to that in a moment, because I do want to just come back to this first point about, sorry, it's a bit thick, isn't it? Come back to this first point about why are we actually looking at this stuff? Why are we even combining profiles? Why are we looking at what we're about to do, and how does that give us trading opportunities? So coming back to what I had mentioned before in the, I believe it was module 4, where I got you doing exercises on depth of market profile. Do you remember? And all it was, the profile was very microscopic. You could almost see 10,313 contracts, etc. So I just made that up, but you know what I mean. And then the profile would be it'd be very thin here, and then it would sometimes bulge out here, and I'm just making it up, but this is a typical shape you might have. And then, do you remember the market was on, this would be your 4 columns, but obviously it's just a chart, isn't it? Chart, 4 columns, whatever. I'm not going to draw out the 4 columns here, but essentially, let's say the market was trading in this region, and then it would pop out, and then we might get some absorption and etc., and then would come back, wouldn't we? And go into, So you'd already have what? Balance here, right? Can you see? It's just balance the way we've been talking about it. This you only know is the depth of market, because I told you, for all you know, this could be volume profile for a week, it could be volume profile for a month, it could be volume profile for a day. You don't know that. And these could just be value area lines for any period. You don't know. But do you see what we were doing now when I was trading the depth of market? I didn't talk too much about value areas back then, because can you see, I didn't want to confuse you. I wanted to do the whole auction market theory section first, so you understood about balance and imbalance. But do you remember what happened in the treasury example? The market popped out, I saw absorption, aggression coming in to sell, and where did I say we'd go back to? Balance. So that was all that was happening. What was the alternative that could have happened here? Just get rid of this, bear with me. Okay, so what was the alternative? The alternative was that we had this area of balance, right? And probably here we'd had balance earlier on in the day, and then we popped up there. So it's a terrible drawing, but let me just even this out actually. Sorry about this. Prefer to be accurate rather than confuse anyone. This may have been earlier on in the day in the treasury market, and then we popped up. Do you remember single prints? Do you remember how I said in the last part A, if the market comes down very quickly, there's single prints? That's all that is, where you get thin profiles with the single prints. I thought I'd just mention that because it was there, but we'll come back to that. If that confused you, don't worry, but I did mention it in part A. But anyway, so we come back to here, and I said the first example was what? That we broke above value, and I saw the absorption coming in, and do you remember I said return to value? Well, what was the alternative, right? The alternative was that we went up, broke out, but we never returned. We never saw absorption. In fact, either absorption came in and it failed, i.e. the people who got short got run over and they had to bail and they started getting long, or we start to see value and then we go imbalanced. Okay, so can you see what's actually happening here? Either we're looking for enough, and I said this to you in module 4, you may or may not have remembered, I know it was a long time ago. I said, oh, we're looking for different areas of balance in a different area to target. Well, do you see, on a depth of market, it's very difficult for me to explain that to you, because as you remember, when I showed you the market profile over multiple days, do you see now why I said that? The depth of market targets could be away on a different day. So that's why I've obviously started to take a bird's eye view, because it allows me to see if the market goes imbalance, where's the next area of balance? So do you remember that essentially we've discussed this to death really, but that the market is balancing and then it's imbalancing, then it balances and then it imbalances, right? That's all it's doing all day long. Why is that? Well, it's got value here, it's got value here, it's got obviously value somewhere else. And I'm not going to repeat this again and again because we have covered this quite thoroughly in auction market theory. So I'm going to skim over this very quickly. But the reason why this is important is because there's only two things. That's the point of me explaining all of this again to you. Is, guys, you've got to understand there's only two things that the market is ever doing. And that is either balancing or it's imbalancing and looking for different areas of value. And we talked about this a million times with bread, do you remember, with chocolate, with however many milk, whatever example I gave. So I'm not going to discuss it here again, but I just want to remind you that there is no other conditions apart from balance and imbalance. And in fact, I want to mention this here because, look, I mentioned it here, market condition, balance and imbalance, but I don't know if you some of you who are from a retail background, it's not like this is never mentioned. You must have heard this before where people say the market's in a range or the market is not in a range, and you need to be very good at identifying when the market is in a range. And you see indicators, and I'm not going to bash them, but I'm going to tell you, in a very, very politely, as in logically, look, think about it yourself. indicators don't tell you when the market is balanced or imbalanced, when the market's ranging or not ranging. Think about it, all these, I mean, you know what I think of them, but moving averages and things, why do you think they don't work? They only work well in imbalanced environments, right? Trending. When the market's balanced, and guys, you've got to understand, about 80% of the time, the market's in balance. And you know, I've talked about this when the market was very volatile during coronavirus and other volatile periods. I've said to you, institutions aren't involved. And I've showed you on the depth of market, it goes so thin. Why do you think that is? Because what it is professional players, institutions, banks, whoever, whatever you want to call them, hedge funds, basically very active speculative players that are responsible for the bulk of volume. The reason why the depth disappears is because they know this. They know that 80% of the time the market is balanced, not imbalanced as in IM, but in a balanced environment, i.e. ranging. So they're very calibrated towards those environments. So when it goes imbalanced, many market players, they don't get involved. Now, I'm not talking, small imbalances. Obviously, when, you have, say, a few days of balance and then you have imbalance and then you have a few days of balance. No, they're very active in those environments. I'm talking about where you have, multiple days, weeks even, of imbalance and huge profiles. They're not active because they recognize that those periods aren't ideal conditions. But my point isn't that. My point is, did you notice how I identified that? So what this will allow you to do is it will develop your understanding of identifying market conditions. And really, that's why I wanted to say all of this, because by the end of, not necessarily the course, but at least over the next 12 months, but obviously this exercise is just really going to get you started at doing that. And that's the point of me getting you doing task 1 is, and why we're doing this. As I said, I want you to really understand the purpose and how this helps you identify trading opportunities. You need to become experts in knowing when the market is, in retail terms, ranging. I call it balance, or not ranging, and you may call it trending, whatever you want to call it, expansion or whatever. Institutions will call it imbalanced. And we already said why that is because what? Aggressive market orders, right? Market orders on the buy side are greater than market orders on the sell side, etc., etc. So look, I'm not going to, again, I keep saying this, but I've explained all of this in great detail about what balance and imbalance is. Point is, we're now going to show you, or I'm going to show you how to identify this market condition. And really, guys, that is all I'm doing. And ladies, that's all I'm doing, okay? All I'm doing all day long in whatever market I'm trading, be it S&P, crude oil, all I'm doing is identifying, is there balance or imbalance? And what it is you'll see, it's not, I wish it was as simple as that. Because there's different investors, there will be people on the depth of market will obviously find particular areas that on a composite might be balanced, but on a microscopic depth of market might be imbalanced. So, that is essentially where I guess you could call it the holy grail lies, but it's not an indicator. It's obviously using a bit of your critical thinking, and really that's where your edge and your alpha comes in, where I've said here, use your judgment. But we'll talk a lot more about that as we develop and introduce all these different lenses. I've already showed you the depth of market. I'm now going to show you composites. I'm going to show you all the investors and what different investors are looking at and how they perceive value, and you're going to have to put all of that together. But look, at the end of the day, I'll give you sort of my chart book as it looks now, and it's got all these different investor perceptions of value. You're just going to get lost, right? I needed to start you off on the depth of market so you could look at how is volume profile built up, and it just happened to be that you got an added bonus of how algorithms view value on a very microscopic time frame. We're now going to move on and look at a different lens, essentially, of static value. okay? But what we're now going to do is, and static versus dynamic, as I said, we will come back to that. I said that in the last slide. But what we're going to now do is we're going to identify this. And I know I've taken a while to go over this first bullet point, but I really cannot sort of say this enough, is that essentially you've got to be able to identify balance versus imbalance, okay? That is all you're ever doing, because all the market is doing is balancing or imbalancing, balancing or imbalancing, balancing or imbalancing. And I have had a few people ask me, well, hang on, doesn't one investor see? So you see here, this could be balance, imbalance, balance, imbalance for an algorithm. And this could just be balance, right, for a sort of bigger term perspective investor. And people ask me that. Look, don't worry about that. I acknowledge that, and I know that, believe me, and we will get into that. And that's where things really do get quite difficult and complicated. Obviously, I'll try and help you manage that, but let's identify conditions first, right? And then we can worry about different lenses and putting it all together. But that's the point, is don't worry about all that stuff about this time frame, that time frame, this investor, that investor. That's all yet to come. Just worry about, is the market balanced or imbalanced? And that's it. Then we'll put obviously all the different perspectives together, okay? So again, just to repeat the point, the purpose and why we're even doing this and identifying trading opportunities is we'll identify balance or imbalance, and what that will do is essentially, I kind of hinted at it, that in balanced environments, I said institutions are obviously calibrated to play that environment, and the reason they take their foot off the gas in or long periods of imbalance is because you trade range or balanced environments differently. So what you'll typically be doing, obviously, is you'll be fading, right? And you saw me do that. You saw me do it on the depth of market, the treasury market. I faded where I thought the market would remain in balance. Do you remember right at the top? But if you can identify that the market is imbalanced, what are you going to be doing? You're not going to be fading the market, are you? Fading as in opposing the market, because you're going to get crushed. The market's telling you something. It's seeking value higher or lower. So let's go with it, right? You call it trend trading. I don't. I call it, there's particular names I give it, okay? And we're going to get onto that, what the exact names are. But the market condition identification that I give it is imbalanced, okay? So I always know from any perspective, again, don't think about the other perspectives right now, but just any perspective in particular, whether the market is imbalanced, i.e. range, balance, or imbalance. Do you see? Where it's seeking value higher. And I talked about this in eBay. eBay's doing it all the time, but obviously it's one direction. The price will keep going up until it finds value. Right? Okay. So we just need to identify, are we here? And then we will identify trading opportunities once I introduce the VWAP. I'll give you a framework for being able to identify how to actually take the trade. So that's very close now. And the same thing, when we identify that the market is imbalanced, okay, then we will now be able to identify trading opportunities to go with the imbalance. We're not going to be trading it the same way that we do balance. So, we need to identify the market condition. Once we've done that, which is why I called it context. It's one of the best traders in the world. And I don't want to bash retail, and forgive me. Look, at the end of the day, believe me, I don't get any pleasure out of bashing retail. That's why I never mention one person in particular. All it is it just bothers me that you're using all these things in all conditions, right? When do you ever say to yourself, do you know what? I've identified this market condition, so I'm going to do things differently, or I've identified. People just don't do it. It's so important. You have to adapt. And I'm going to teach you how to do that now by showing you that the market changes from balance to imbalance, and the trading style that we use to take advantage of that is different. So first we need to identify it, right? So secondly, areas to conduct business. Context. So what I mean by that, right, is exactly this. So what have we just been talking about? We said that the market is balanced and then goes, once it gets out of balance, gets imbalanced, right? And it seeks value high, and then suddenly will go balanced, won't it? Now, how many times have you seen that? Where you try to ride the trend and it just suddenly, it goes flat, okay? Now you know why that's happening, because the market is found value. It's no longer imbalanced, okay? So we need to identify that. How do we actually identify that? Context, contextual levels, okay? You've already seen it. It's value areas, basically. Value area high, value area low, okay? So if we know that that is the value area low and that's the value area high ahead of time, would you agree? We can start to book profits, right? If we go into this previous balance area, which is what? Just a profile from before. Do you see why I call it static? Because it's static. It's not changing. It's already done. It's historic. When I get into this region, am I going to start trying to play what you call, again, I don't, as you know, I keep saying it to death, I don't call it trend, okay? I call it imbalance, but so I'm going to use those words now. But is trend as what you're used to? So let's just say it one final time. Am I going to be looking for trend trades in this area? No. Can you see the power of identifying market condition? Because as soon as we get into balance areas previously, we saw this in bread. Do you remember the bread price came down and then it got balanced after it had been imbalanced for a while? The market's happy. Why? Why are you trying to trade trend, as we call it, or retail calls it? Why? Why are you trying to, do you see? It's not what you want to do. When you're in a prior area where the market has clearly told you with transactions that, look, I'm happy here. As soon as you get in here, stop that type of trading and switch to balance trading. And this will become very clear. You know, like I said, I'm going to have VWAP with the standard deviation bands, and we're going to look for trading opportunities. So that's all to come. Very exciting stuff, and I will get you very much taking opportunities in the style that I'm describing now, balance and imbalance opportunities. So, but to do that, we obviously do need some levels, don't we? Where we can say, you know, so we've got a profile here, we've got a profile here, and, you know, let's say the market's here. We need a level, don't we, to say, well, if we start to build value here, is that still balance or imbalance? Well, we need a contextual level to identify when the market condition has changed. Well, if we have this level, which is the whole point of task one, essentially, you're identifying this level. Okay, so, and I'm going to show you how to do that. Composites, joining up the profiles together, and then you get these very nice value areas where you have obviously very nice normal distributions with perfect, not perfect, but, you know, more ideal characteristics that allow us to see balance. Again, repeating a lot of what I've said in the past, but, you know, obviously I like to do that. So just to make sure that not 90% of people get it, 100% of you get it. And then, yeah, so like I said, if we start to build value above, I can say to myself in my prep, oh, you know what? The market's imbalanced right now. So let me look for imbalanced opportunities, but to where? I need to have areas, do you see, that I'm targeting. It's not always going to go there, but come on. You always need a business plan, don't you? Where's your target? What do you expect to achieve? When you run a business, you're always looking for what? What am I likely to achieve in price? Well, this gives us the bottom end of a previous balance. I expect imbalance to sort of get into, ideally into this range, but at least here I can start booking profits. And then if we get in here, I'm done. I'm no longer looking for imbalance. And if I get some balance opportunities, and start fading like we did on the depth of market, where we look for absorption and then reversion. Whereas here, we're not. We're looking for absorption here on the south side to fail and aggression to come in, going upwards, boom, and we got a nice contextual level up here. Can you see how it's starting to develop trading ideas? Because no longer are we just looking at nothing. We're actually looking at contextual levels. So that's the point of identifying, and I know I spoke a lot about that, but it was important that I explained why we're even doing this exercise. And task one is to identify areas for us to do business, but more importantly, identify the market conditions so we know how to conduct business. So I just want to speak a little bit before I move on to the next slide about composites. So I already talked about it in part A, that we're combining obviously balance areas together, value, but I cannot stress this enough. There's no magic formula. There are going to be times where it isn't obvious what you should do. And the reason I point this out to you is because I know there's going to be, and I've seen it time and time again, I know there's going to be a lot of people who get obsessed with, oh, what's Envy doing? Do you see? So you might have value area here for one day, and then you might have a value area here where it slightly overlaps. Do you merge them? Do you not merge them? Some people will say, do you know what? I think there was enough value here that balanced. You see it there, this sort of little area here where they both balance. Some people will say, yeah, do you know what? I think that was 2 days that from a value perspective were very close together, so I'm going to join them together. Whereas someone else, you might say, no, do you know what? It wasn't. And that's my point. You've got to understand, there's no magic formula. And I'm going to talk about this a little bit, become obvious as we go on, that I would really be very careful how you approach this. Be loose with it. And the reason I say this is because, think about it, right? This really comes back to the reality check and the thing I said about alpha. And I cannot stress this enough. I'm going to really try and stop myself talking about it too much here, because I want to really talk about this more towards the end of the pro course. But I did mention, and I hinted, alpha, to generate alpha, you've got to be doing things that are a little bit outside the box. Because otherwise, think about it. If it was obvious, right, where value was 100% of the time, I promise you, someone out there with millions, if not billions, and there are institutions out there with that sort of money, I know, because I work there. And I used to actually develop algorithms and, I saw how much money these guys had. If stuff like this was too obvious, that doesn't mean that it's not useful for us to do it. In fact, it's great. My point is, if stuff like this was too obvious, someone would program it. And believe me, the fact it isn't, and you're going to see, the fact it isn't always clear is an amazing thing, because it allows you and I to do what? Develop edge using human characteristics, i.e. analytical capabilities that a machine can't use, because we have to apply discretion, and therefore I don't think people will quite grasp this until much further in their career. What opportunity I am giving you to generate alpha. Okay, now you might think to yourself, do you know what? Oh, it's a cop-out. Envy's not giving us something very like A plus B must equal C, because if we don't get it, then he has an opportunity to say, oh, it was you. But you've got to start approaching this differently. You've already tried that way, doing all the retail methods where people tell you, no, you do this and do that and this should happen. At the end of the day, why do you think the failure rate is so high, even in institutions? Because we are told the same things. Guys, when I went and done my, obviously I had 2 trainings, as you know, in investment banking, and then proprietary training I had. There's so many people around me who got told exactly what I did. Why did they fail then? They obviously got told the same things I did. No, it was because I recognized early in my career, hang on, I got to start to recognize things before the crowd does. Now, I'm not saying that, at the end of the day, other people won't recognize what you're doing. They will, and you want them to. It's just you want to recognize it earlier, and therefore